Hi everyone! Welcome back to the channel. Today, we're diving into the world of life insurance benefit distribution, tax implications, and special situations. Whether you're studying for your insurance license or just looking to understand life insurance better, this video is for you. We'll break down complex topics like beneficiary designations, tax treatment of life insurance, and special provisions like the Spendthrift Clause and 1035 exchanges. Let's get started. 1. Benefit distribution. First, let's talk about benefit distribution. When a policyholder dies, the death benefit is distributed to the beneficiaries. There are two main ways this can happen. 1. Distribution by descent. Per capita, benefits are evenly distributed among all living beneficiaries, e.g. their surviving children. Per stirpes, benefits are distributed according to family lines. If a beneficiary dies before the insured, their share goes to their heirs, e.g. grandchildren. 2. Distribution by order of succession. Primary beneficiary, the first in line to receive the death benefit. And secondary contingent beneficiary receives the benefit if the primary beneficiary dies before the insured. Tertiary beneficiary, third in line if both primary and secondary beneficiaries predecease the insured. 2. Distribution to an estate. If no beneficiaries are alive at the time of the insured's death, the death benefit is paid to the estate. However, this can lead to probate fees, estate taxes, and potential claims from creditors. For example, if a policyholder names their spouse and daughter as beneficiaries, but both die before the insured, the benefit goes to the estate, not to other family members like sons or siblings. 3. Distribution to a minor. Life insurance companies typically won't pay proceeds directly to a minor. Instead, a guardian or trustee must be appointed to manage the funds until the minor reaches legal age. Alternatively, the insurer may hold the proceeds and pay interest until the beneficiary is old enough. 4. Distribution to a trust. Naming a trust as the beneficiary is a great way to manage proceeds for minors or other beneficiaries. There are two types of trusts. Testamentary trust, created after the insured's death through a will. Trusts provide control over how the proceeds are used, but may involve administration fees. 5. Facility of payment. The facility of payment provision allows the insurer to pay proceeds to someone who appears entitled to them, like a person who paid for the insured's final expenses. This is often used when no death claim is filed within 2 months of the insured's death, or when a minor is the beneficiary. 6. Special situations. Let's talk about 2 special situations. 1. Uniform Simultaneous Death Act. If the insured and primary beneficiary die in a common disaster and it's unclear who died first, the insured is presumed to have survived. 1. The benefit goes to the contingent beneficiary. 2. Common disaster provision requires the primary beneficiary to outlive the insured by a specified period, e.g., 14 to 30 days, to receive the benefit. 2. Otherwise, it goes to the contingent beneficiary. 7. Spendthrift Clause. The Spendthrift Clause protects beneficiaries from creditors. As long as the proceeds are held by the insurer, creditors can't access them. This clause also prevents beneficiaries from recklessly spending the money by requiring installment payments instead of a lump sum. 8. Tax consequences of life insurance. Now let's discuss tax implications. 1. Premiums. Not tax deductible for individuals, but maybe for employers or charitable contributions. 2. Death benefits. Generally tax-free if paid as a lump sum. 2. Installment payments may include taxable interest. 3. Cash values, tax-deferred growth. 3. Surrendering the policy may trigger taxes on gains over the cost basis. 4. Policy loans, generally tax-free but reduce the policy's cash value. 5. Accelerated death benefits, tax-free for terminally ill policyholders. 6. Dividends, tax-free as they're considered a return of premiums. 6. Interest on dividends is taxable. 7. Modified endowment contracts, MECs, taxed differently with penalties for early withdrawals. 9. 1035 exchange. A 1035 exchange allows policyholders to swap one life insurance policy, endowment, or annuity for another without immediate tax consequences. For example, you can exchange an old policy for a new one with better benefits or higher interest rates. However, you can't exchange an annuity for a life insurance policy, as this would convert tax-deferred funds into tax-free benefits. And that's it. We've covered everything from benefit distribution to tax implications and special situations. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more insurance tips. Leave a comment if you have any questions or topics you'd like us to cover next. Thanks for watching, and see you in the next video.